Now, after learning horizontal and vertical trend analysis, how to perform it, and now we will move on to next financial statements analysis technique, which is known as the ratio analysis. Now, in ratio analysis, what will happen? The person who is doing the analysis will calculate some predetermined ratios. You would have heard ratios such as gross profit ratio, net profit ratio, current ratio. Now here we will use those techniques for financial statement analysis. Now in ratio analysis, what will happen? The ratios will be computed on the financial statements using the figures, and those ratios will be interpreted, compared, and based on those ratios the decisions will be taken. Example, the gross profit ratio, gross profit divided by revenue into 100. Gross profit ratio will be computed for two businesses in the same industry and will be rank those businesses. The ranking will be done based on the gross profit ratio. Same way, you can calculate current ratio and compare between industries and between organizations. So, what will happen in ratio analysis? In ratio analysis, financial ratios will be calculated, accounting ratios will be computed. Those ratios are predetermined, defined ratios, as I told you, like gross profit ratio, current ratio, net profit ratio. We will learn those, how to compute those. And those ratios are based on financial statement line items, and those ratios are used for interpretation, analysis, and identification of comparisons between the organizations. Generally, we have to identify what are the limitations of ratio analysis. Now, ratio analysis is a very good financial analysis analytical tool, but that has some limitations, drawbacks. First limitation of ratio analysis is it is using historical data. Now, example, the ratio analysis is done for the previous financial statements, most recent previous financial statements. So, revenue, gross profit margin, net profit margin, all those ratios will be computed. But that's already past, previous financial figures. So ratios are also sometimes maybe outdated. So one limitation is that it is using historical data to compute financial statements. Number two, use of averages. Sometimes, since you don't have the exact figures available, you have to calculate ratios on averages. This may not represent a fair reflection of the operations of the business. And sometimes ratios lack comparability. If one organization prepares ratios, the other organization may not prepare ratios because they don't have proper accounting function. If an organization doesn't have an accounting function properly, ratios cannot be computed. So poor comparability is present. So ratio analysis is dependent on accounting function. If the accounting is not present, ratios are unable to computed. So limitations are there. Usage of historical data, so no use for future. Use of averages and lack of comparability over the years. Now we will see how to use ratio analysis for financial statement analysis purpose. Now, for ratio analysis to be most effective, you may use these techniques. So you can use calculated computed ratios from previous years and you can establish a trend. That means, as an example, gross profit ratio of several financial years can be computed and you can identify how the gross profit has changed from year to year. Now let's assume another example. Let's assume you computed the net profit ratio. We will learn what is net profit ratio, like net profit divided by revenue or sales into 100. Now, can compute the net profit ratio for several financial years, 2019 and 2018, and identify what's the trend in the net profit. Ratio analysis can be used for that, to identify trend. And maybe for historical as well as you can use that for budgets as well. The management can communicate the organization in future, next financial year, or in 5 years time, 3 years time, needs to achieve a gross profit or net profit of this much. Or organization can use ratio analysis to compare in the same industry. Example, let's say net profit ratio or gross profit ratio of one business can be compared with the same ratios of another business, and in the industry identify which one is more superior than the other. Consider other factors as well. Always ratios, do not take it ratio itself. See the other factors as well. Sometimes some business is performing better than the others due to some other reason other than the financial ratios. So consider them as well. So you can use the ratios for different purpose, as I told you. Can compare over the years how the trend is there, relationships in the industry, forecast for future, for budgets and all. So ratios are actually a very good essential tool in financial statement analysis. So now we will move on to some practical ratios. First one, return on capital employed. See, we call it ROCE, return on capital employed. This is expressed as a percentage. How to compute that? Return on capital employed means the profit, the return that is earned for the capital employed in the business. The profit, the return that is earned for the capital employed in the business. So the ratio is like this: profit before interest and tax. There is a financial statement line item called profit before interest and tax, that divided by capital employed. Profit before interest and tax, PBIT, divided by capital employed into 100. Now, if the organization has given the final profit, what the student has to do, add back interest and tax. So then you will get profit before interest and tax. Let's say after tax, after interest and tax profit is given, add back interest and tax, then you will get profit before interest and tax, divided by capital employed. Capital employed means total value of equity. That means equity means shareholder capital, stated capital plus reserves plus all the non-current liabilities. That's the capital, bank loans and everything. That's the total value of capital employed in the business. So capital employed means stated capital, shareholders capital plus reserves plus long-term loans such as banks and debentures, bank loans and debentures. That's capital employed. So profit before interest and tax, PBIT, divided by capital employed into 100 will be return on capital employed. There is another ratio, return on assets. Profit before tax and interest divided by total assets into 100. PBIT same way. If the PBIT is given as itself, you can use it, or else profit for the year, final line, plus interest plus tax. Then you will get the before interest and tax divided by total assets. Total assets means current assets plus non-current assets, property, plant and equipments. Current assets plus non-current assets, total assets into 100, return on assets. Assets cover. Asset cover means how much of revenue can be covered for the assets. How assets are covered by revenue. That means sales revenue divided by total assets. Once again, revenue means the income statement's top line divided by total assets. Total assets means current assets plus the non-current assets. Final one, gross profit margin. In your income statement, gross profit line divided by revenue line into 100. That's how gross profit is performing. So once again, I am going after these profitability ratios, how profits are done. Profit before interest and tax, PBIT, or else profit for the year plus interest and tax divided by capital employed. Capital employed means, yes, that means stated capital, equity plus reserves plus long-term loans like bank loans and debentures into 100. Next one, return on assets, profit before interest and tax divided by total assets. That means current assets plus, yes, non-current long-term assets into 100. Asset turnover, revenue divided by total assets. Then gross profit margin, gross profit divided by revenue into 100. Then net profit margin. Net profit margin, the ratio is profit before interest and tax divided by revenue into 100. You can use this for comparisons. Profit before interest and tax divided by revenue into 100. Then the efficiency ratios. Efficiency means how efficient the business is. So that can be computed. Ratio number 1, receivables collection period. That means receivable collection period means how quickly the business recover its dues from its customers. How quickly, number of days, that is taken by number of days. So how quickly, if you sell to a customer, if you sell, how quickly the amounts due for you is recovered. So it will be calculated trade receivables divided by revenue into 365. That shows how quickly the organization recovers its dues from its debtors. Payables payment period. That time we call it creditors settlement period. That can be computed by trade payables divided by cost of sales into 365. That means how frequently, how quickly the organization pays its creditors after purchasing. In 1 month's time, number of days you get. Now, inventory turnover period. Inventory turnover period means how long the inventory is there, in the company's warehouse. How long the inventory will be there stored at the warehouse. So closing inventory divided by cost of sales into 365. All these ratios, receivables collection, payables payment and inventory turnover period, all these ratios are computed as number of days. That's why you multiply that by 365. Once again repeating, receivables collection period, trade receivables divided by revenue into 365, payables payment, that means how quickly you pay, trade payables divided by cost of sales into 365, inventory turnover, closing inventory divided by cost of sales into 365. So final set of ratios. Liquidity ratios. Liquidity means how effectively company can settle its short-term debts. How effectively company can settle its loans, debts in short term, in quickly. How quickly company can settle its dues. So liquidity. First liquidity ratio is current ratio. That means current assets of the company divided by current liabilities. Current assets, the total current assets figure in the statement of financial position divided by current liabilities is your current ratio. So current ratio should be more than 1, they say, as a rule of thumb. Generally, a company should have more current assets than its current liabilities, because more inventory, more receivables, more prepayments and more cash should be there than the current liabilities. That means the creditors or maybe accruals, things like that. So current ratio should be generally more than 1. Then quick or acid test ratio. This should be more than 1, more than 2. Generally represents 2 is to 1. That means current assets on top line, on the numerator, from current assets, inventory should be reduced and the figure should be divided by current liabilities. So current assets minus inventory is divided by current liabilities. This should be more than 2 to 1. That means for 1 unit of current liabilities, for 1 unit of current liability, there should be 2 units of current assets minus inventories. Generally, why you compute a current ratio and a quick assets ratio? Because in current ratio, even though you get current assets figure, there are something like inventory which cannot be sold quickly. So you need to identify quick assets ratio, assets which can be sold very quickly in terms of your current liability. So current ratio is computed first ratio in this slide. Current ratio is computed as current assets divided by current liabilities. Then quick assets ratio is calculated by current assets minus inventory divided by current liabilities. That's quick asset ratio. That's short-term liquidity. Short-term, how company can pay off its creditors. Then the last ratio, gearing ratio. Gearing means how well the company's financial structure is. That means how well, how the debt of the company, loans, long-term loans of the company in terms of the total equity of total capital of the company. So you will get debt. Debt, generally you will get the long-term debt, long-term loans like bank loans and things. Debt divided by debt plus equity. Equity means shareholder capital into 100. So when the debt portion goes up on the numerator, that means company's gearing is in a trouble. When there is more debt, the problem is more for the company. So debt divided by debt to equity, debt plus equity into 100 is the gearing ratio. So always you have to compute these ratios, align that to the financial statement line items, do the comparisons, then your ratio analysis is done. So the decision making will be done in that way.